Okay, so recap from yesterday. Thank you for everyone for showing up to our classes today and for making the class today. For those who weren't here last time, a little recap of what we did. We basically learned how to create a business plan. We went over the steps on how to adequately maintain our business and then how to reach out to others, how to pitch our business plans to others to get investors. And so we decided to start today off with a quick practice, a quick exercise to get you guys thinking about how to have your posture and everything when you pitch to others. So there's going to be a quick debate and there's 4 prompts. And then this side of the room is going to be yes. So if you think that the prompt, okay, for number 1, if you think there's going to be more doors than the world, you're going to stand on this side. And then if you think there's more wheels in the world, you stand on that side.
There's obviously more wheels.
And then the point of the debate is you're going to have people going one by one, and then you're going to state your opinion on the thing. And then we have to have, remember keeping our things from yesterday, what we learned, keeping your eye contact with other people, making sure you stand up straight. And we're just going to practice all those skills, with your debate with your peers today. Okay, so for the prompt number 1.
So prompt number 1, we said doors. If you think there's more doors in the world, move physically to that side. If you think there's more wheels, move physically to this side. So if you're sitting over here, stand up and move.
Go guys, go!
The wheel side. It's not the wheel side. You can leave if you want to.
This is questionable because it's pet door and car door. Yes. Okay, so do you think there's more doors in the world or wheels in the world? Okay, this is wheel.
Alright, everybody, we're giving you 1 minute to discuss among yourselves, and then we're gonna get people to come up with the front and explain their point of view.
Discuss amongst yourselves, and then we're going to have people come to the front. At the final, we're going to have everyone vote, and then the majority side wins. Okay?
Okay, everyone has to go. So
Basically,
first of all, cars do not count because for each car there's 4 doors, 4 wheels, so cars are out of it. What? Dude, cars, they have 4 wheels. This is the wheel side. And also, you can't use cars because there's also 4 doors in the cars. Not all cars have 4 doors. Yes, there's a limo. We only have 2 doors. And there's cars that, and 4. There's more wheels because why? There's cars that have there's cars that it's basically only the head. Tanks. Some doors. Some doors have. Yeah, sliding doors. Are you here? So that's what. Why is everybody? First of all, there's obviously more wheels. We all agree on that. Yeah. Stop. Stop. Even a little Lego thing. Hey, I think it's actually.
dare you change sides now. They just said wheels.
But then when they say doors,
Okay.
car doors.
1 minute is up. So we're gonna have people from both sides come up to the front. You guys can choose a representative from your team to just tell others what your team believes. Okay. So from the wheel side.
Shut up. Me.
Yay. So there's obviously more wheels and doors because there's sliding doors, there's bicycles, there's shoes with wheels, and we can't include cars because there's four wheels and 4 cars, but we can include tanks. And another thing are hinges. For each door, there's many hinges, so at least 36. So for each door, there's hinges inside. So yeah, if each door has 36 hinges, the more doors there are, the more wheels there are. So that's why there are more wheels.
Okay. Does the door side have a rebuttal? Say why you believe this.
the Lego or any little building. And like in this building, we have more doors.
We're not taking questions.
Questions?
No, I know.
Okay, look. The only thing on the side are houses and buildings. But what do we have? We have tanks. Okay, we have an idea. Okay. Scooters.
Alright.
Hinges.
Alright. Hold on. First of all, hinges are not wheels.
Wow,
That's an executive decision. We're gonna do the next. We don't have a lot of time today, so we're just gonna go on to the next prompt. All right, that was good. All right, so prompt 2. If you like pineapple on pizza, go on that side. If you don't like pineapple on pizza, go on that side.
It's good on pizza, but
Pineapple?
I say no.
Pineapple belongs on pizza.
I'm like right here.
You can decide in your mind. Do you know give us
Mine is in the middle.
No, sit down.
I know. I'm going this way, but I'm not entirely against pineapple.
If you've never tasted it, just imagine if you think it should be on pizza or not. If you think it should be illegal, then stand on the side. But if you think it's okay to have it on pizza, stand on the side.
Oh, it's okay.
Like, I don't like pineapple on pizza, but I'm not against it.
One minute to discuss.
It's good on pizza, eat it.
Whatever you want.
Like,
Okay. That's time's up. Okay.
You don't over here.
I'm not like, I only like I just don't like that. And so, I'm here.
So one person in this room likes pineapple on pizza?
I don't like it, but I don't like no. I don't
Wait,
If you don't like it, stand on this side. If you
No,
like it, stand on this
but I
side.
do think that pineapple should be on pizza.
In the middle.
There
Like,
you
no,
go.
in the middle. In the middle.
Here.
In the middle.
Fine.
In the middle. In the middle.
Wait.
All right, hold on. Pay attention.
Okay, we're gonna choose one person from each side, and then they're gonna try to convince someone from the other side to go to their side. Okay? So
This is don't like.
this is don't
This
like
is like
pineapple.
pineapple. This is like pineapple.
So someone from the do not like pineapple.
Is it okay if I'm like in the
Guys, right there.
I don't like pineapple on pizza, but
Okay.
Yeah, you never tried it.
The guy in draft drinking the water. Can you stand up and come to the front and tell people why you think pineapple should
Do you
be
think
on
pineapple should be on pizza?
Everyone else listen up.
Everyone else listen up.
But it's just about pineapple could be on pizza or not pizza.
Reed, do you like pineapple?
I'm saying, does
All right,
pineapple
all right,
belong
I
on
answered-
pizza or just like
This is. All right.
Hello everyone. In today's debate, I'm gonna explain two things. First, why is pineapple pizza more popular? And second, why does pineapple taste better? First, we know that there are 3 main popular pizzas in America: Hawaiian style, plain, and pepperoni. Okay, maybe I don't like pepperoni because it's too salty. And the reason why plain pizza is popular is because there's vegans in America, there's other peoples that maybe, for example, maybe Muslims, they want to eat pork. So there's this culture in Silicon Valley that, for example, they only eat fruit salad or plain pizza during the party so that there isn't some guy getting embarrassed and they can't eat stuff. Well, as I said, pepperoni pizza is salty, so that's why we think Hawaiian style, which is the one with pineapple, is most popular. Secondly, why does pizza with pineapple taste better? Okay. Pineapple is a little bit sweet, it's juicy, right? Maybe meat is a little bit salty, it's dry. The flour is flour. The cheese doesn't really, the cheese is pretty good, but it isn't either salty or sweet. Now with pepperoni pizza or plain pizza, I don't really get the flavor, right? For pepperoni pizza is too salty. There isn't a thing that is really sweet or juicy that makes it a better flavor. But in the Hawaiian style, we have meat, which is salty, and pineapple, which is a little sweet and juicy. That makes it a better pizza. Thank you.
Alright, somebody from this side want to volunteer?
No, but
No pineapple.
So go on this side.
Cindy, do you have a parent to share?
Sneak.
Mommy,
Where am I going?
come up here and explain.
Okay, so I've never tried pineapple pizza. I've never liked pineapple, so that's why I don't think pineapple should be on pizza.
That's an opinion.
Exactly. My opinion.
That's an opinion.
Okay.
That's just a, well, that's
I didn't want to go up.
opinion.
Next slide.
Okay, everyone can go back to
Alright.
their seats now.
If we have time, we'll come back to the last two prompts.
Okay.
Alright, are we back? Yeah? You ready? Alright, so next topic we're going to talk about is customer service, right? Big part of a business is customer service. If you don't have customers, you don't have a business. And you want to keep your customers happy. So we're going to go through an activity, basically going through how you're going to interact with the customer in like 3 different scenarios. We're doing finance or what are we doing? Alright, we'll come back to it. Alright, we're gonna come back to that too. Well, let's go into stocks. Who here knows what a stock is? Yes.
It's like a part of a company that you can like buy and, well, you can just like, I don't know how to say, it's like, it can go up, like the price can go up and down, and like sometimes you have to predict like what will happen.
Yeah, that's a great definition. It's just, that was great, but in other words, basically you're taking partial ownership of a company. By buying a stock, you own a small fraction of that company, and if the overall valuation of the company goes up, then your money goes up as well. So, alright, so stocks are traded on a stock exchange or a stock market, which is basically a system for buying and selling securities or stocks and bonds. This word is basically the same thing as stocks and bonds. So basically, whenever you guys are too young, but if you guys set up like investment account, you guys can do that under your parents. You guys can buy stocks, right? And like you said, stocks can either go up or go down. You guys kind of have to do some research into what type of company you want to invest in. Because like I said, by buying a stock, you're taking partial ownership into whatever company that you want to buy. So if you figure out that you want to buy this company, you would place a trade on the stock exchange that the company is on.
Yeah, so next up is a famous historical event that's related to the stock market. I don't know if you guys know, but in October of 1929, there was a really big stock market crash. And the reason why was before that, a lot of people did a lot of like reckless spending in stocks. They saw that other people were making money off of the stocks. So they're like, if other people can do it, why can't I do it, right? So a lot of people wanted to buy stocks. However, they didn't think this through, right? Buying stocks, you have to be able to predict a company's future and whether or not you should invest in them. So if you recklessly buy into all of these stocks, there's going to be negative consequences. And that's what happened in history, right? So because of everyone spending so much money on the stocks, when the company started to not function as well, when the company started to lose money, everyone started pulling out, right? Pulling out means like when you're buying a stock and you decide to sell off your stock so you don't lose more money, that's what it means, right? But if one person decides to sell off their stock, then another person might be like, oh, well, if this person thinks that this business is not worth like investing into, then maybe my investment isn't a good decision either. So if one person does it, it might cause another person to do it. This eventually led to a very tumble because more and more people decided that they didn't want to invest into these businesses, and that's what eventually caused the stock market crash on October 19th.
All right, next we're gonna go into why everybody wants to invest in the stock market, even you guys, and that is because we want to make money. Okay, that's the main reason you want to invest in the stock market. Stocks are one of the highest risk, highest reward investments that you can go into because the annual rate of return for the stock market is 9%, something around 9% right now. So let's say you put $100 into the stock market today. Next year, same day, you would have $109 on average. That's just how normally the stock market works. Usually other forms of investments are like houses, right? You can buy real estate or bonds, different things that you can buy. The stocks have the highest rate of return, but they also have the highest risk, meaning you could lose all of that money as well.
Okay, so we're going to learn some basics of investing by watching the following video.
What is investing? Investing is an action you take with your money to make it grow. There are many things you could invest your money in. Some popular options for investing are stocks, bonds, and real estate, all of which help your money grow. When you put your money in these avenues, they become your investments. We publish a video every week, so please click subscribe if you haven't already. It's free. Can you give me an example of how my money could grow when I invest it? On average, the stock market provides a return of around 11% per year over the long term. If you invested $5,000 in the stock market today, then in 20 years, you would have around $40,000, and in 30 years, you'd have well over $100,000, all from just the original $5,000 investment. That's the power of investing. You could turn $5,000 into well over $100,000. How much money do I need to start investing? There is a common misconception that you need a lot of money to start investing, but that couldn't be farther from the truth. Even if you set aside just $1 every day for investment, that money could grow into over $70,000 in 30 years. Who should invest? Is it only for adults who have a steady income? Absolutely not. Everyone can and should invest whatever amount they can. It doesn't matter whether you're a kid, teenager, young adult, an employee, entrepreneur, or a stay-at-home parent. You should invest your money so it can grow into a lot more money over time. When should I start investing? The best time to start investing is now. The earlier you start investing, the more time your money has to grow. Let me give you an example. If you invested $1,000 when you were 40, the money would grow into over $40,000 when you're 60. But if you invested the same $1,000 at age 20, you'd have over $400,000 when you're 60. That's the power of starting early. But, like we mentioned earlier, you don't have to wait until you save up $1,000 to start investing. You can start by setting aside as little as $1 or $2 a day and invest the savings at the end of each month. Now, you have no excuse to not invest. Thank you very much, Wall Street Willie. You're welcome, Super Cooper. Remember, finance is your friend.
Alright. So that was just a basic video. I kind of already covered what they talked about, but yeah. So just to reiterate really quick, the best time to start investing is now. I know you guys think you're young, but you guys can literally have your parents set up youth investing accounts for you guys, and they can start investing for you guys for the future, for college, and all of that. So talk to your parents if you guys want to start investing right now. Okay, next thing we're going to talk about are IPOs. Does anybody know what an IPO is? No? Okay, does anybody know what a startup company is? Okay, let's say I wanted to start a company today, right? I wanted to sell lemonade, and I started my own lemonade stand. That is a startup company, right? I just created a company from scratch. I might not have that many customers yet, but I started put my first foot forward and I started this company. That's a startup company. And there's so many startups around the world, and when these startup companies get big enough that they want to be publicly traded on the stock market, so their stock is available for people to buy, when they're that big, usually they're worth a couple $1 billion, that's when they do an IPO, which is an initial public offering. So they start selling their shares to the public. That's basically when, for companies that you believe in, that's probably the lowest possible money amount that you can buy the company's specific stock for. So when the companies first start off as a startup, they're very small, right? And then they IPO, and that's how they get super big. Should I show them the chart of like Apple? Okay. So let's take a look at Apple stock. We're looking at all time, right? So they IPO'd in, let's say 1983, and they're like a couple cents, 0.09 USD, 9 cents, right? And right now they're at $190. So if you bought the stock when they IPO'd, you would make, your return on investment would be, let's see, $211,766%, which is crazy. You would have millions of dollars, right? So if you believe in a stock and you think it's gonna grow, IPOs are a lot of the time the best time to buy into that stock.
Okay, next we're gonna talk about ETFs. Anyone know what ETF stands for? Okay, that's okay. So ETFs are exchange traded funds. Okay, let's think about it this way, right? If 3 of you guys go to a store, right? And all of you guys wanted different toys. These different toys were in 3 separate stores. But these 3 stores were super far away from each other. So if all of you wanted all 3 toys, then all of you would have to walk from one place to another. And you guys are like, this is too much work for us, okay? So you guys just decided to stay in one place. So how do you get all 3 toys together then? You decided to have all your money put together, right? Imagine she had $5, someone had $10, someone had $15. If you put them all together, and then the 3 of you guys decided to buy a toy like mixture. In this toy mixture, it had a little bit of everything. So it had the toy that one person wanted, a toy that another person wanted, and a toy that a third person wanted. Basically, this is the same thing as an ETF. Because when you buy an ETF, you're basically buying stocks of different companies, but in a bundle together. So these stocks can be from companies such as for technology, for food, for entertainment. And what this allows for is basically, instead of putting all of your money into one stock, like you're focusing all of your money into like an Apple stock or something, you're diversifying your portfolio by spending a little bit of money in different companies. This way, it's less riskier for a person because if you decide to spend all of your money into one stock, what if that company like goes bankrupt, right? Then you would lose a lot of that money because you invested so much money into it. But if you bought an ETF and then have all of those companies together, it would be like if those companies did well, then your money would go up. But if all of those companies did bad, it wouldn't be as bad as investing all of your money into just one stock.
Okay, next thing we're gonna talk about are dividends. Okay, so dividends are things that stocks basically pay out. Certain companies offer these dividends. So for example, let me think like Target. If you buy a couple shares of Target and you just hold the stock for a year, they're gonna pay out a small percentage of that money just because you're a part owner. That's basically them rewarding you for owning the stock. You're not really doing anything, but just because you bought the stock and you're owning the company, they're paying you a small percentage of that stock, like 3% of however much money you're owning. And that's just a nice reward, again, for buying stocks. If you have the money in the bank, maybe you're making interest on it, but is nowhere near the percentage that it would be if you're investing in the stock market, or you could be buying stocks that also pay you dividends just for owning the stock.
Okay, so next let's watch a video on some basic investing tips.
Every day, billions of stocks are traded on the New York Stock Exchange alone. But with over 43,000 companies listed on stock exchanges around the world, how do investors decide which stocks to buy? To answer this question, it's important to first understand what stocks are and what individuals and institutions hope to achieve by investing in them. Stocks are partial shares of ownership in a company. So by buying a stock, investors buy a share in the company's success or failure as measured by the company's profits. A stock's price is determined by the number of buyers and sellers trading it. If there are more buyers than sellers, the price will increase, and vice versa. The market price of a share therefore represents what buyers and sellers believe the stock, and by association, the company, is worth. So the price can change dramatically based on whether investors think the company has a high potential for increasing profitability, even if it isn't profitable yet. Investors aim to make money by purchasing stocks whose value will increase over time. Some investors aim simply to grow their money at a faster rate than inflation diminishes its value. Others have a goal of beating the market, which means growing their money at a faster rate than the cumulative performance of all companies' stocks. This idea of beating the market is a source of debate among investors. In fact, investors break into two main groups over it. Active investors believe it is possible to beat the market by strategically selecting specific stocks and timing their trades, while passive investors believe it isn't usually possible to beat the market and don't subscribe to stock picking. The phrase beating the market usually refers to earning a return on an investment that exceeds the Standard & Poor's 500 index. The S&P 500 is a measure of the average performance of 500 of the largest companies in the United States, weighted by company valuation, meaning that companies with a higher market value have a larger effect on the S&P. Again, market value corresponds to what investors believe a company is worth rather than actual profits. The S&P doesn't directly represent the market as a whole. Many small and mid-range stocks can fluctuate according to different patterns. Still, it's a pretty good proxy for the overall market. It's often said that the stock market behaves like a voting machine in the short term and a weighing machine in the long term, meaning short-term fluctuations in stock prices reflect public opinion, but over the longer term, they do tend to actually reflect companies' profits. Active investors aim to exploit the short-term voting machine aspect of the market. They believe the market contains inefficiencies, that stock prices at any given point in time may overvalue some companies, undervalue others, or fail to reflect developments that will impact the market. Active investors hope to exploit these inefficiencies by buying stocks they think are priced low. To identify undervalued stocks, they may investigate a company's business operations, analyze its financial statements, observe price trends, or use algorithms. Passive investors, by contrast, put their faith in the long-term weighing machine aspect of the market. They believe that even though markets may exhibit inefficiencies at any given point, over time, those inefficiencies balance out. So if they buy a selection of stocks that represents a cross-section of the market, over time, it will grow. This is usually accomplished through index funds, collections of stocks that represent the broader market. The S&P 500 index is one of many indexes. The overall goal is the same for all index funds, to hold stocks for the long term and ignore short-term market fluctuations. Ultimately, active and passive investing aren't mutually exclusive. Many investment strategies have elements of each. For example, choosing stocks actively, but holding them for the long term as passive investing advises. Investing is far from an exact science. If there was one foolproof method, everyone would be doing it. has someone tried to recruit you into a company that seems a little, well, sketchy? Don't ignore the red flag.
Okay, right after we saw that video, we learned that investing is a little bit tricky, but if you guys practice enough times, we'll get the hang of it, okay? So to help you guys like reiterate that video a little bit, we're gonna be playing this Kahoot.
Alright, so questions are gonna show up. If you know the answer, just raise your hand, we'll call in.
So investing is a way to grow your money. Money buys investments with the goal that they will be worth more money over time. Let's take a closer look at investing. Okay, this is just personal opinion. How much do you guys know about the stock market?
Yes. A little?
Okay.
Alright. If you own a share of a stock, you
Own part of the business.
I can't see it.
Own a part of the company.
Do you own SCT, own a treasury note, or do you own part of a company?
what color? What color? Yellow?
Yellow.
It is yellow. Good job.
Bro, that's so bad. It doesn't make you want.
So a share of stock is worth a certain percentage of the company. If the business makes money, then the value of that stock can increase. If the business is not profitable, an investor could lose the money. True or false question. Bonds are money you loan to a business or government to be paid back with interest.
You might know this one.
Who thinks it's true?
Who thinks it's true? Raise your hand.
1, 2, 3, 4, 5. Who thinks it's false?
Alright, false.
False? Okay.
It's true. It's true.
Yo, get out of here, boy. Trust the instinct.
So basically bonds, they don't return as much as stocks do, but they're also less risky. So if a company runs into trouble, the bondholders will be paid out before shareholders. So if you own a bond, it's a lot less riskier than if you own a stock.
But bonds, you get less money though, right?
Okay, next is the ETF we talked about. So the ETF is a collection of assets. Some invest in one industry, like technology or real estate. Other types, known as index ETFs, may invest in hundreds of companies to follow the overall stock market performance. So like the name might suggest, ETFs are they sold only through fund managers, sold directly
What
by
color?
companies?
Blue.
Yeah,
Blue?
blue. That is correct.
Good job, guys. Yeah. So ETFs are bought and sold on stock exchanges.
Okay, sometimes companies share their profits with shareholders.
I talked
Every
about this
knows.
one. I talked about this one.
Good. So they are payments to company shareholders based on the company's profits and the performance, and it's usually in the form of cash. Okay, true or false? The price of a stock always matches its actual value.
Alright, raise your hand if it's false. Raise your hand if it's false. False.
False?
Yeah, it's false. Like that video we just watched, it explained how there might be short-term fluctuations based on different news that may affect the company, but over the long term, that more accurately affects, basically represents what the company's growth is. So a company's price will not always basically match up with its actual value.
If there are more buyers than sellers.
We talked about this.
Increase.
Increase.
Dude, if there's more suppliers, it goes down. More buyers will go up.
Rate of return. We talked about this?
Okay. So the rate of return is basically a percentage change in the value of an investment over time, and it's compared to the cost of the original investment. So there is like a certain formula when we calculate rate of return. It's basically the ending value subtracting the beginning value, and all of that divided by the beginning value, and then multiplied by 100.
That's for the percentage. What's the rate of return here?
Did anyone get that formula from earlier?
45%? Wait.
15%.
45's not on there.
Blue.
Kind of. Oh yeah, 45%. 45%.
That's 55.
Alright, who thinks it's yellow? Raise your hand. Yellow. If you think it's green, raise your hand.
They did you two answers.
No.
From 5.
Alright, it's green.
Yeah.
Yeah. 50%. Alright, think about it. This is math. We're gonna do a math lesson real quick. Alright.
You said it's so many.
Look, 1,000. What's half of 1,000?
500.
500. How much more is 1,500 than 1,000? 500. So this is 50%. Do I need to explain that again? Alright, here.
Do you understand the formula?
Say clearly.
Okay.
You say that.
That 1,500 is the ending value. So that's like, if you're trying to calculate it at a point, that's like when you start, right? Subtracted by 1,000, which is the cost in the beginning, and then divided by the 1,000 because that was the beginning value, and then that equals 0.5. And then if we want to find a percentage, we multiply the decimal by 100, right? So 0.5 times 100 is 50%. Yes?
So next we're going to talk about investment risk. So of course when you buy stock there's risk, right? You can lose your entire investment if the company goes bankrupt. But stocks are also one of the highest reward, basically the highest chance to go up as well. So there's always a chance of losing money, but there's always a chance of making money too.
So you can diversify investments by buying what? Just like we talked about when we talked about the ETF, if we always invest in only one company, that means we're putting all of our money into that one company. So if that company goes bankrupt, then all of our money is gone, right? So how can we diversify our investments? By investing in multiple different businesses. That way, if one fails, you still have another to cover your right?
What do you guys think?
Diversify the money in any investments.
Everyone says blue.
Blue?
Blue.
Blue?
It's incorrect.
Yeah.
If an investment has a very high expected return, what kind of risk is there for losing
Talking
the
about
investment's
this.
money?
High risk? Yeah.
I expected
Okay, so capital gains. They're basically the amount of profit that you make when you sell an investment. So end value minus beginning value. This is basically how much money you're making.
Okay, which of the following does not represent a
stock that's $20,000 and it later sells for $20,000, you made zero. It's not a capital gain.
Which of the following is not a good scenario for considering more risk?
You really believe in the future earnings of the company.
We'll call it.
That's taking risks.
Hi, yellow, blue. Which one?
Blue?
Are you sure about that?
Oh.
I told you. It's wrong. Yeah, but I didn't confirm it.
Go. Okay, so if you want short-term like gains, it's better to, or it's gonna be safer to at least invest in lower risk investments that are more stable, because like despite the stock market going up and down, it's gonna like over time, like we've seen, like during the pandemic, a bunch of stocks went down, but like over time they usually go back up again. So higher risk investments are better for long term. Podium.
Oh my gosh.